That's right, guys. Tiger Quant is here, and we're doing the series on leading indicators as well as the regime indicators. We have 5-part series on several topics. We're kicking it off in such a way so we can help you a bit to navigate the current market, be it in crypto or be it in the stock market. It's an interesting market. It's a confusing market. So today we're kicking it off with the first part of the indicators, or one of the first indicators, and it's essentially bonds and equity rotation, which gives us a good sense in terms of shifts from bull to bear market regimes. In the future, we're also going to cover leading event indicators, specifically market breadth, RSP broadening versus SPY, VVIX and VIX and VIX term type of indicators, as well as the credit spreads, and a couple of other things. There's some exciting things that are coming, such as the kill switch with the Lupyanov chaos theory and a physics engine, and some cool stuff on the crypto side. We may mix them up in one way or another. So today we're kicking it off with bonds and equity rotation, but we might just actually follow up with USDT dominance, which very much is focused on the crypto. And by the way, those two are very similar. In an essence, the bonds and equity rotation indicator is essentially a way to track flight to safety when the money is rotating from the market into long bonds. And in case of USDT.D dominance, well, that's essentially when the capital is flowing into safer stable coins like USDT and USDC. And essentially, typically, the money goes in and either being staked or just taken out of the market. But the concept is very similar to the correlation of bonds to markets. Anyway, those are probably the two first ones we're going to cover. Today, we're focusing on bonds and equity rotation. Let me take you through a few key concepts. There's very much 3 parts to the presentation today, or the video today. One is we going to expand and explain how the bonds and equity rotation indicator works and why it works. Second, we will actually look at the examples of the 2020 crash as well as the February 2025, which is interesting to see and understand. And then we'll spend a bit of time talking about the market today, which is obviously critical for you to grasp and also get a sense of how to use basically the ratio and the indicators we provide to understand where the market is going and when and how to respond to it. Okay, so let's talk about the whole aspect of the bonds and equity rotation indicator. So the key concept here, again, as was mentioned in the beginning, is the rotation of the capital from the market into safety position with long bonds. You can visually see here there is sensing, and then the movement of the bonds that typically go up, TLT, and then SPY is going down. And essentially, that's what gives us the sense. It's very much a ratio indicator. The key difference, I guess, for us is that over the period of time as we tested it with TLT and SPY, we ended up landing on actually using more TMF and ES, which is basically the long bonds leveraged product, 3x leveraged product. And then basically ES is the futures for the S&P 500. And there's a good reason for that. So let me just cover it briefly and give you a bit of a sense. So number one, this 3x leverage magnifies the subtle moves and shifts, and it's actually an advantage for us in terms of picking up on the movement. In terms of the ES, it gives us the 24 or 23-hour liquidity, so it actually captures overnight flows and it gives us a better understanding. And then overall, with those two, it gives us a much cleaner microstructure for the ratios. And so we use TMF /ES ratio. It gives us the right type of insights and timely signals. You can get, and you will get that Miro Board, so you can spend a bit more time learning about it in more detail. There's additional explanation slides here, so I'm not going to spend too much time on it right now. I'm just going to quickly highlight how we actually accomplish it. So in addition to taking the ratio, we use our indicators. So in this case, we're using our dual base indicator on the ratio. And as part of that, there's really 3 layers that play a key role in terms of picking up the signals in the right way. So number 1, or the layer 1, here it's an adaptive or dynamic gamma, which is Kaufman adaptive moving average. And it's a specifically tailored indicator that we developed with our own concepts and our own efficiency ratio, plus the noise filtering. Then we combine it with cycle intelligence, so we can actually gauge what is the typical cycle of that ratio and how to capture the information. We look at velocity and we look at some of the microstructures behind it. And then we look and leverage actually the hidden Markov models, which is a way to predict the signal basically a couple of bars in advance. Ideally, we get it 3 to 4 bars in advance. Given the fact that other indicators are more lagging, it may give us an advantage of up to 5 bars. All in all, depending on the level we're on the chart. So for example, when we look on a chart, and we'll do it today, at a 4 days level, it could give us between 4 to 12 days leading edge in terms of the signal. I think that's really the key on this on that summary. So let's shift into the into TradingView and take a look. So we prepared it a bit in advance, and so let me give you a bit of a overview and a and a concept behind it. So we essentially looking at the TMF slash ES ratio, and that's what we see right now on the screen. In advanced state, we put some of the lines in here. So the red lines are essentially when we're going into the bear market, and the green line is when we're going into the bull market. Because we're using TMF divided by ES, it's an inverted ratio, and therefore the signals are also inverted. So, for example, our latest signal came in sometime in February 6th, and that's actually not a good signal. That's a signal that gives us a sense that we're going into bear territory, and you've seen it in the last couple of days. That's how it's playing out. And so for us, it's going to be all about actually monitoring it and watching what's going to happen next, and then looking for reversal. By the way, just to orient you, I'm on the chart that I'm looking on 4 days time frame. We're also using Henki-Ashi type of candles because it gives us better trends. And so then moving back, let me show you a few other interesting things. So you can clearly see the green line is a shift to a bull market. So here, the last one was on 27th of October 2025. So if you remember, we had a bit of a slowdown, and then there was a shift. And then after that, we had a period of upside movement, which is essentially captured here. In the same way, if we're going to continue to go back, you're going to see some of the movement and change on July 28th. That was a bear period of time. What's more interesting, I also want to highlight to you how nicely it catches the whole bull market, which essentially started in April 2025, and it was a bull market for both crypto and for the equity. But that's a nice catch over here. It actually catches it on April 7th, so April 12th. And by the way, if you look across, we're using our signal. So the arrow down is essentially sort of the negative ratio or the bull market. The T signal is the top signal, so it catches it nicely here. You can also use it or catch it in the regime indicator up above. And then, excuse me, and then we also have an indicator down below here, which is much more, I guess in some ways, more advanced indicator because it allows us to capture the movement of what we call the adaptive RSI or GRSX. And so it also catches it just in time. So it's fully reflected here. You can see the dates. And if you're going to look across and look at it on your side, you'll see the dates correlate with some of the key changes in the market. If we go all the way back in time, we're actually going to see it as well at the time of the 2020 crash. So that's an interesting example here. And we'll look at it also on the chart in a second. So you can actually see that we got a signal on January 21st, 27th. That was essentially the beginning of that crash, which is essentially a very timely signal. There was a movement in the negative direction, some retracement, and then the real crash kind of started in February 12th. And so this is basically the movement up. You see the wild fluctuation as the bonds essentially skyrocketed. The market was falling. And then you get the top signal here on essentially April 3rd, or kind of the end of March. 30th, basically the end of March, and April 3rd is basically the following date in April. And then you have a long period of the bull market that followed. What's nice about it is essentially we're using the duo-based indicator, and more recent version of it includes the predictive model for hidden Markov models that actually predict those signals earlier and more timely. So that's a nice enhancement. And then if I look at that same combination over here for the 2020 crash, and I look essentially at the that same time frame, you're going to see over here that was the January 27th. That's essentially the signal that came in here. Then we kept moving forward. There was even a short reversal. It's quite typical when you have a bit of that double top before the major crash. And so then, if you remember, I mentioned that it was about February 12th that we got an additional confirmation. So essentially, with that support of the TMF/ES or bond/equity rotation indicator, we would be on a high alert. We would be probably exiting here somewhere at the top. It would go through the full crash, and then we would end up somewhere here at the bottom where the reversal is essentially happening on March 30th, April 3rd. We actually, using our indicators, we get even earlier signals here with a bottom signal and then the buy signal that follows. But essentially what I'm showing you here is the TMF/ES indicator gave a much earlier warning in terms of the exit. And so that helped us quite a bit. If I shift to the second example, which was basically the more recent example in 2024/25. So at the end of 24, beginning of 25, I was just showing that before. So let me just again highlight it in the TMF indicator. So if we look at it again carefully, that is essentially the signal on January 28th, 2025. That is the signal for the warning of the shift in the market. It becomes essentially a bear market for a period of time until April of 2025. And this is essentially what is reflected on this chart over here. You get an early signal here, a warning on January 28th, January 30th. We're going sideways at the top, and then we have a crash that follows. Now, the situation we're facing right now in the market today is in many ways similar. We've been in somewhat of a sort of topping, rolling top pattern for quite some time. We got this signal for the bear market confirmation fully in the beginning of February. It was quite evident even at the end of January, but essentially that's a good confirmation to track it truly. It's essentially a leading signal before we have a much more significant correction. So right now, what we essentially see is that it's moved against the market. There was a pullback that we all sensed in the last couple of weeks. But then the other aspect of it is quite often you have a bit of a pullback and then it's probably going to continue up. Now, I cannot fully predict it. As we mentioned, based on our additional models, we estimate probably up to 12% pullback in this type of setup. But if we are essentially looking at it from those indicators, the reversal on this time frame back to the bull market, or essentially the sell on that ratio, that's what's going to give us a sense that probably we are finishing the correction and then we can shift our execution. Well, it took me a bit longer than I was planning. Thank you for your time. This is one of the first videos. We were planning to make them a bit short, but I think we took the right amount of time to explain how it works, and hopefully you're going to appreciate it and start using it on your side, getting a bit of a sense what's happening with the market, not just looking at individual stocks, but also understanding in what regime you're actually operating. Thank you, and have a good day.